Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. The RBI announces a second round of Operation Twist within a week of completing the first one, aiming to ease borrowing conditions in the market. SEBI fines ICRA and CARE Ratings 25 lakhs each for failing to carry out proper due diligence while rating non-convertible debentures issued by IL&FS. GST officials unearthed a tax evasion racket which created fake invoices worth 1,600 crores, helping avoid 241 crore rupees in taxes. And gold is set for being the biggest annual gains since 2010 as prices surge past the $1,500 per troy ounce mark again. And we were talking about this yesterday, that Indians would be a happy lot with gold doing what it is doing. But we'll get to that in a bit. Maybe a conversation a bit sometime next week on gold as well could be warranted. But first, what about today? Well, the cues aren't bad. The US markets had a fairly decent outing. The Nasdaq topped the 9,000 mark for the first time. This is a record high for the Nasdaq. And well, on the back of that, on the back of the tech stocks, S&P 500 and Dow Jones too had a fairly decent outing. So the world markets or the US markets, the mother market is in a ship shape. Look at that number, 30 to 39. 2 months ago, we were at 3,100 talking about the possibilities of 3,200. I think the year-end rally just continues and techs are leading that move upwards. Now, there are a couple of very interesting charts, one for the US markets and one for the Asian markets, or one for the world markets and the Asian markets as well on the Bloomberg, which are bringing it out. And as much as people would want to say that this rally is overdone and the cheer is overdone, it just continues. Look at the bottom half of the chart, which just shows how the markets have just blown past the resistance levels and are refusing to make a comeback. Typically, the markets have tended to retreat from these levels as the red line shows, but this time around there is no stopping. At some point of time it will stop, but for now it just continues. And as I said, it's reflecting on the rest of the markets in some way. Nikkei may be quiet, but Shanghai is up about 0.5%, Hang Seng is up about 1%, and the Asian screen is, well, maybe underperforming both on the valuation front as well as the price performance front to the US markets, but it is doing well too. However, you would have to admit that while we talk about what's happening, Asian stocks are much below their record high amidst the global rally in the past. So maybe, just maybe, there is hope for emerging markets in Asia to do well. The SGX 50 indicates a start which is marginally in the green, and this might be helpful because yesterday also, if you saw what happened, and the trade setup kind of lays that out, right? Because if you just look at what happened in trade yesterday, it was essentially Reliance Industries and HDFC Bank, two names which contributed to the lion's share of the fall. Between them, they contributed to nearly 45 points of the downtick. Had that not been the case, the markets would not have looked as bad. And mind you, if you look at the market breadth or the performance of the mid caps and the small caps, they didn't go down as much. I mean, 0.07% for the mid cap, 0.08% for the small cap, and the advanced decline was actually in the green. So the market breadth looked okay. It's just these two stocks which corrected. And frankly, if look at that, the 798 to 721, this is as of trade yesterday. And frankly, if banks stabilize today, and the belief is that Reliance, after having fallen so much, might actually see some bit of bottoming out. They might actually have a bit of a rebound in the market. So let's wait and watch. If they start in the green, might actually hold out, and if banks bring us forth to the green as well. So those are a few things that I would watch out for. Not too many stocks really to monitor today. Adani Ports, LIC's increased the stake to about 11.82% from 9.82%. And frankly, it makes sense to keep some of these Adani Group stocks in focus. The group is on a deleveraging drive. Every now and then we hear some news flow, and all of these stocks are so active. The biggest name of them all hasn't rallied thus far. Maybe it will be its turn. Watch out for Inji Infra. It's a small stock, but it's been declared the L1 bidder for a small project in Haryana. So I'll watch out for this one as well. And last but not the least, the stock which hit life highs yesterday was up 5% on close, which is Dixon Technologies. At about 1,300 or thereabouts. Now MK has come out with a note and they've raised the target to 4,475. Multiple points of rationale that the MK has put out, but essentially you don't argue against a trend, and the trend is that some of these back-end manufacturing stocks like Dixon and Hindustan Foods, etc., are doing well. Do watch out for Dixon Technologies in the session today as well. However, let's tell you what's lined up on First Word. Is a collection of the top editorial stories that we want to bring to you. Darshan first runs us through what the global brokerage houses have to say about Indian equities in 2020. City gas distributors find their spot under the sun in 2019. Somit tells us why. Gold loan companies made the most of the gold rally, and Shefali takes us to those details. And Advait explains why the RBI has chosen to announce its second round of Operation Twist in such a quick succession. We also speak to Ananth Narayan about it. Brokerage houses seem split on their opinion on how 2020 will shape up. While all of them expect the benchmark indices to post healthy gains over the next 12 months, some believe that the narrow breadth of the rally might continue. Darshan Mehta is standing by to tell us what the 5 key global brokerages have to say about 2020 and the Indian stock market in that period. Good morning, Darshan.
Good morning. So no one talks about major outperformance coming in. But some of them do believe that it may outperform the emerging markets, but no major, targets that were given. So let's start with the Morgan Stanley, and their view is that India is likely to outperform the emerging markets on 2020. The other point is the Sensex target that they've given. 45,000 is the base target that they've given. They see a 50% of probability that will happen, and a bull case target of 50,000 and a bear case target of 35,000. So that's a 25% probability for each of them happening. So that is there. The key triggers that they believe that will likely play out for 2020 is, first of all, they believe in a pickup for the investment cycle. They believe there will be accelerated government expenditure which will come in, and there could be a pickup in exports. So these are the themes that they are betting on this front. They've also talked about some of the sectors and the stocks that they're bullish on. In terms of sectors that they are overweight on, consumer discretionary, industrials and financials are something that they're overweight on, and they remain underweight on sectors like technology, healthcare as well as materials. The other one is UBS. Now UBS has given a target price of 12,300 for the Nifty, and that is by June 2020. So there's not enough potential upside as of now, because the Nifty is already at 12,200. In the bull case, obviously, is 13,300, so another 1,000-point rally, and the downside is 10,300 according to them. In terms of sectors and stocks that they are underweight on, auto, IT and small and mid caps are something that they are underweight on, but a whole host of stocks they are bullish on, and most of them are pretty much the Nifty 50 stocks, be it an Asian Paints, Axis Bank, there is Cipla which they are bullish on, Reliance Industries, SBI Life, NTPC. So some of the large caps are something that UBS is bullish on. Credit Suisse is slightly cautious. What Neelkanth Mishra has indicated in his note is that economic slowdown may worsen, but they've given names of almost 9 stocks they believe will be they overweight on, including SBI, Bharti Airtel, Dr. Reddy's, a lot of financials here, ICICI Bank, ICICI Prudential. They like Lupin among the pharma space. Tech Mahindra is there. Tata Steel, Neelkanth has always been bullish on the metal space, so that is the view that Credit Suisse has. Citi also has a view on the market, and they are saying that the macro recovery will be protracted, and earnings expectations are extremely high. And when they had come for the preview this thing, that time also they had indicated that they don't see much upside, and that's why the Nifty target for December 2020 is 12,700, which means just a 400-point upside on the Nifty. Overweight on financials, healthcare and industrials, and underweight on consumer staples. Materials, except for cement, they're bearish on it, and autos are something that they're bearish on at this point of time. And finally, JP Morgan has a view, and one of the views that they are saying is that there is high EPS growth and lower policy rates. That is something that we need to watch out for. In terms of top picks, there is banking space that they like. So there's ICICI, HDFC Bank and SBI. Ambuja and NTPC figure among them. And while Credit Suisse likes Lupin, it's in the least preferred lot for both Godrej Properties and Lupin were in the preferred picks for Credit Suisse, and it become the least preferred for JP Morgan.
Interesting. Darshan, was there a single strain which was common amongst all of these? I heard you mention that not too many people are believing that we'll outperform massively.
Yeah.
But besides that, was there a single strain in a sector, in some themes, etc., that they're putting out? Yeah.
So not single theme, but I think the targets that they've given for the Nifty and Sensex do indicate that there will be limited upside. That is, there hardly 300, 400, 500, 1,000 points at best is something that they believe on the Nifty. So not too much optimism, because I think most of them believe that earnings growth probably has not come in, and it will take time for that to kick in.
Okay, Darshan, thanks so much for putting this into perspective. So that's what brokerages believe, or large brokerages believe India could do. Mind you, this Monday we'll also give you a sneak peek, or we'll actually give you a complete lowdown of what large swaths of the market believe the markets could do as well in a poll that will be coming up in about 2 days from now. So, well, you've got more reasons to stay on to BloombergQuint and BQ Live as well. Moving on, as the world continues shifting to alternate energy sources, India is not far behind, and one sector that's benefiting from this shift is city gas distribution. The stocks too are finding favor in the market. Somit Sarkar is here to tell us about the stellar rally that we've seen in these companies this year. Somit, good morning.
Good morning, Neeraj. So if you see in 2019, other than Mahanagar Gas, the other two major city gas distribution companies, that is Indraprastha Gas and Gujarat Gas, have gained over 60%. For gains for Gujarat Gas and IGL were nearly 68% and 62%, and that for Mahanagar Gas in 2019 was close to 16%. Now, the reason behind this lower returns by Mahanagar Gas was mainly because of an overhang of promoter stake sale, and secondly because of subdued volume growth performance that we had seen in 2019. And if you see the volume growth performance for the quarterly earnings reported by all the three city gas distribution companies in 2019, for Gujarat Gas, the volume growth for Q3 and Q4 FY19 was weak, but it picked up from the start of financial year 2020, and that was on the back of the NGT order, which forced the industrial users in the Morbi region to shift to gas. And that is the main reason why the company has been able to report a volume growth of 42% and 39% in the first quarter and the second quarter of financial year 2020. For IGL, volume growth was consistent. It reported double-digit volume growth in the last 4 quarters. For Mahanagar Gas, volume growth was in high single-digit for the first two quarters, that is third quarter and the fourth quarter of financial year 2019. But going forward, it worsened to low single-digit in FY20 due to a decline in offtake by the state transport units and due to temporary gas disruption seen in the first quarter and in the second quarter of financial year 2020. On the unit profitability front, if you see, Gujarat Gas benefited the most due to lower raw material cost, while Mahanagar Gas benefited on the back of price hikes. And for IGL, unit EBITDA was consistent, barring just one quarter in the last 4 quarters that the company has reported. However, going forward, now government's push towards cleaner fuel by introducing stricter norms, along with this development of new city gas distribution areas which were awarded in the 9th and the 10th round of city gas auction, and the declining prices of gas will not only aid the consumption of gas in the country, but also benefit this city gas distributors going forward, that is in 2020. Now, among the three city gas distribution companies, Gujarat Gas is expected to benefit the most. Its volume and EPS is expected to grow at a CAGR of 20% and 37% over FY19 to FY22, largely on the back of higher consumption coming in from the industrial clusters, development of new areas, and due to lower raw material prices. For Indraprastha Gas, again on the back of expansion in new areas, pricing power, and lower raw material cost, the company's volume and EPS is expected to grow at a CAGR of 11% and 20%. However, in case of Mahanagar Gas, analysts are expecting a lower volume growth of 5.5% over FY19 to 22, as its growth has now been saturated and it didn't manage to win any new areas in the latest round of city gas auction. However, that's what fundamentally the city gas distribution companies are expected to report. But over the next 12 months, if you see from share price perspective, due to this run-up that we have seen in all the three city gas distribution, the returns are expected to be subdued for the next 12 months. Now, analysts are expecting Gujarat Gas return to be around 13% over the next 12 months. For Indraprastha Gas, they're expecting a downside of 2%, and for Mahanagar Gas, they're expecting a return of only 8.5% over the next 12 months.
So it seems to be that everybody believes that the companies have run their course,
yes,
unless fresh triggers emerge.
Exactly.
Things won't move. I'm just wondering, Somit, what could be a fresh trigger? There is a capacity that is laid out. The circles are given out as and when they are given out. What could be a potential fresh trigger, if at all?
If there's a higher than expected volume uptake, because if government actually goes on and puts a ban on the industrial clusters and say that you have to forcibly shift to gas right now or else you won't be able to start the operation, then that would lead to a very high uptake, as we had seen in the case of Gujarat Gas. As you can see in the chart also, up till Q4 FY19, the volume growth was subdued, but it picked up nearly 42% in the first quarter, and that was because Gujarat government had actually put a ban on all the industrial industrial organizations organizations in the Morbi region who were not using gas, because of which we had seen such a high uptick in volume growth. And if that is the case, that comes in for all the regions in which the city gas distribution operates, then that could be the trigger point for all the 3 city gas distribution companies.
Thanks so much for your perspective. That's Amit Sarkar with a small piece on how the city gas distribution companies have been. Now, our headline mentioned that gold has done well. 2019 has been a great year for that commodity, or the precious metal really. And gold loan companies like Manappuram and Muthoot Finance have made the most of this rally. Shefali Malik is standing by to tell us more about this. Good morning, Shefali.
Good morning. So both the listed stocks, the leading ones, Muthoot and Manappuram, they've done very well this year. Muthoot Finance returns of about 45% and Manappuram 85%. So what are the factors that led to this rally? So after September 2018, when the IL&FS crisis broke out, so the main issue with the NBFCs was that they were borrowing short term and lending long term, which created asset liability mismatch for most of the NBFCs, especially the real estate focused ones and a couple of others, even the vehicle finance NBFCs. But what got differentiated for these NBFCs was the completely opposite. So they were borrowing long term and lending short term, which created very favorable asset liability position for them. And also to top it up, the gold prices also kept on rallying during the year. Right now also at around 2 months high, so we did carry that earlier. So that basically what that does is that raises the value of collateral which people are offering, and because the gold prices are higher, so that gives them more incentive to pay back their loans on time and get their property back. So that does not lead to asset quality issues for these gold finance companies. And other than that, because of the appeal of these gold loans, this product as well, because I was just looking at the rates that MFIs offer and what gold loan companies offer, and gold loan companies offer it at a much lesser interest rate. So because of the appeal of these products, even the gold loan demand has gone up, and these companies have grown at a very steady rate of about 10 to 15%. And in last couple of years, 2-3 years, these companies have basically diversified to basically de-risk their books. They've gotten into housing finance of very low ticket size, vehicle finance, MFI. So these books constitute a little chunk as of now, but still they've moved towards that direction. So what's in store for these companies going forward? So I'm quoting BOB Capital, what's their outlook on the industry. So they see about 10% CAGR to about 3.6 lakh crores over FY19 to 22, and NBFCs will continue to account for about 25% share of that growth. Banks still do a majority chunk on the whole, and out of that 25% share that NBFCs have right now, Muthoot and Manappuram will continue to maintain their market share of about 80%. And going forward, both these managements are bullish of maintaining the steady growth rates. Muthoot sees about 15% growth rate in assets under management, and they think that the pricing power will also continue. The spreads will continue to remain around 12% for them. Manappuram, however, is slightly cautious. They've cut down the tonnage growth in gold to about 10 to 12% versus about 15% guidance earlier. But if you actually top it with the rally in the gold prices, the AUM growth may be a little higher. And how the valuations stack up at this point in time for FY21, for Muthoot it's about 2.2 times, which is just at par with the 5-year average. For Manappuram it's 2 times, which is slightly below 2.14 times. And how the analysts think at this point in time, so for Manappuram 69% have a buy rating, for Muthoot 83%. That's probably because Manappuram has gone up much more than Muthoot, and about 8% of the analysts have hold rating on Manappuram, 16% on Muthoot, and 23% have a sell call on Manappuram, again because of the rally, the stronger rally that we've seen in Manappuram, and nobody has a sell call on Muthoot. Return potential from here on, 4% for Manappuram, 3% for Muthoot.
But that's what happens with some of these companies, isn't it? All those companies which have a fabulous run, say for maybe an HDFC Bank, have a very measly return potential because analysts can't foresee what these companies could do after the mammoth rally that we've had in the valuations that we are trading at, and some of these at least. But Shefali, interesting perspective. Thanks so much for for giving us that. That's with regards to the gold loan companies, and frankly, while NBFCs have largely had issues, Manappuram and Muthoot haven't quite had that. And again, a conversation with Manappuram and Muthoot coming up next week to try and understand all of this. So it'll be very interesting to see what they have to say about how business would look like going ahead. Last piece on First Word is arguably the most important ones. The RBI has announced its second Operation Twist in quick succession. The banking regulator, which had simultaneously bought and sold long and short-term bonds on Monday, will do another one next week. Advait Rao Palepu explains why the central bank may be doing so in such quick succession.
The Reserve Bank of India on Thursday announced a second round of its simultaneous bond purchase and sale policy as part of the Operation Twist strategy. The central bank will purchase on aggregate 10,000 crores worth of longer dated government securities which mature in 2029 and will sell shorter dated securities which mature in 2020. Similar to the auctions conducted on the 23rd of December, on the 30th of December, the RBI will purchase and sell these government securities in order to push longer term yields downwards while the shorter term yields go upwards. Bond markets experts had anticipated multiple rounds of these special open market operations by the central bank as the term premia, or the difference between the 10-year government GSEC yield and the repo rate of the RBI, has been elevated for several months now, despite the RBI cutting its benchmark policy rate. Further, they also said that due to anticipated fiscal slippage by the government, essentially Operation Twist helps fund the fiscal slippage by the RBI consistently purchasing government securities.
Yeah, well, let's talk about this with none other than Ananth Narayan, professor at SPGN Institute of Management and Research. He joins us right now. Ananth, so good having you. Thanks so much for taking the time to do this call. Now, I heard your whole conversation with Ira when the first mention of this Operation Twist happened last week, and you were prophetic in that sense that you believed that that would not be a one-off. My question is only that did you expect the second one to come in such quick succession?
Morning, Neeraj. Actually, the whole market expected that we'll see multiple such Operation Twists, so I won't call myself prophetic in that sense. Yes, we did expect that they would come in reasonably quick succession.
Okay.
Look, the RBI has been very clear, and the governor has been very clear for the need for coordination between fiscal and monetary policy. Once it declared its intent to go into an Operation Twist, the intention is very, very clear. And in the short run, for traders, it makes sense to go with the RBI. The ability of the RBI to achieve its objectives in the short run is pretty high. And I think that's kind of playing out here. Also remember that anyway for bonds, this is a positive period in multiple ways. You know, in January, we have a lot of redemptions coming up, which means the replacement demand for bonds from banks, etc., will be pretty high. So that, alongside this RBI's Operation Twist, will keep bond markets happy, at least in the short run. Of course, what happens in the medium to long run is a very different story. But for now, bond markets will celebrate.
Yeah, one of the things that people mention is that whether the RBI, in a manner of speaking, is without a choice, because with the yields at the longer and even after coming off from those 7.82 levels and the levels that they are at right now, the FPI buyers are still absent, and therefore the RBI will have to resort to this in order to kind of course correct the high yields.
I guess you're right, Neeraj. Look, a couple of things. One is bankers have been complaining that high, long-term yields of government bonds is coming in the way of transmission. Remember that the RBI has cut, or the MPC has cut rates by 135 basis points, but the actual borrowing rates for clients has come down barely by 50 to 55 basis points. And one of the excuses is this high-term premium. The second part, as you rightly mentioned, there is a mismatch right now between supply and demand for government bonds, particularly with the fiscal deficit looking really, really difficult, and with household financial savings having come down over the last few years. At the moment, the government and its affiliated bodies are borrowing far more than you and I are saving collectively as a household. So to that extent, that gap has to be breached. Yes, foreigners coming in would have been one way of doing it. It's not happening. So yes, at the moment, the RBI is stepping in. So for both for transmission as well as for bridging this gap between demand and supply, the RBI is coming in. Effectively, though, RBI coming in and buying bonds, whether we like it or not, becomes a print and spend operation alongside a fiscal deficit that's pretty loose at this point in time. For now, because inflation and current account deficit are not a problem, it seems fine. But I'm personally always wary of print and spend operations that go on for too long.
Yeah, and this may not be the end of it, but just one question, Ananth, since you brought it up 2 days ago or 3 days ago, the yields for a momentary measure in the afternoon hardened when the news came out, or at least one of the officials was quoted as saying by Bloomberg that the divestment of BPCL and some of the other assets might not happen in the current financial year. I mean, left of that, we're staring at a certain miss on the divestment target unless the government pulls out a rabbit out of the hat. Would you reckon that that would keep a lid or temper the optimism on this despite Operation Twist? Or would this and maybe a couple of other announcements that come in from the RBI be enough to pull the yields lower from where they are right now?
So as we've discussed, Neeraj, in the short run, I think the bond markets will stay positive. It doesn't make sense to go against the RBI in the short run.
Right.
RBI's intent is very, very clear. Second, as I mentioned, there are redemptions coming up. And even for the medium term, there is this talk of index inclusion of Indian bonds into global indices, which will keep the mood positive. But you're right. In the medium term, the root cause is the fact that our fiscal deficit is looking in pretty bad shape. Look, I'm not so worried about the disinvestment target. BPCL can happen the next fiscal. The problem is our tax collections are looking really pathetic. Until YTD October, it's barely grown by about 1% year on year. And at a time when the budget was for 25%. Likewise, we are talking of more tax swaps as a counter-cyclical, to counteract the slowdown in the GDP. So at the moment, our fiscal deficit is looking really, really loose. Now, a lot of people say that's okay because of the nature of our growth right now. But I do worry that prolonged use of fiscal and monetary levers is like using a painkiller and using a palliative at the time when the disease is deeper. It takes away attention from the more required reforms. And, you could end up with an overuse of steroids and painkillers, which actually aggravates the problem.
Yeah, well, actually, Ananth, and as we wrap up, that was essentially the nature of my question. So let's assume that because of the near-term, the impact of the moves, as well as you said, the placement of a lot of redemptions and therefore placement demand for bonds could be high in the month of Jan. My question is, on the sentiment post-Jan, Feb, March, April, May, if we miss the divestment target, and there is, as you said, fisc looking loose, even if optically in the budget they maintain a number which is acceptable, people would probably see through and then try and say that the actual fisc deficit number is much different than what the government is saying. In light of all of that, and rating agencies having come out and said that if indeed there is economic growth not picking up, which is likely as well, then there might be some rating action, etc., etc., etc. What happens to the sentiment then, the period post-Jan?
I think that's a great question, Neeraj. Look, in the past, or in the recent past, the RBI and the government have had the benefit of having lots of degrees of freedom. Remember, inflation has been very low the last year. Likewise, your current account and your external balance is looking fairly robust. In fact, the RBI has been mopping up dollars and reserves are at a record level. So, the argument is, even if fisc becomes loose, even if there is printing of money happening effectively by the RBI, as long as inflation and the external account don't show up, where is the problem? And that's the counter-argument that votaries of using the fiscal lever use. But here is the point. We don't know how this will play out. Already, there are signs that inflation may have bottomed out. It's not just food inflation, by the way. With the welcome rebound in the rural economy, we could even see core inflation starting to surprise on the upside. And we could see prints of 6% in the next couple of months. And it could stay sticky on the higher side. Likewise, look, the improvement in the current account is because of the slowdown. Because we're going through this very, very sharp slowdown, import demand has come down, and even gold imports have come down. That could reverse if you see inflation going up and if you see consumption going up again. And you could see, and remember, oil is again back at $68 on the Brent. So, so far, RBI and the government have had huge amount of degrees of freedom because our inflation and our external balance has remained very, very benign. I worry that beyond January and beyond February, these degrees of freedom might come down, especially if the overall global context turns adverse. That's the problem when you play with a print and spend strategy. You're hoping and praying that the overall context remains benign. What if it doesn't? And last bit, I do expect a cyclical rebound in growth, and it will be welcome, right? So you'll see automobiles growing again, you will see telecom maybe reviving again, and all of that adding to growth. If the actual credit growth comes back in the system, even a bit of it, which is absolutely non-existent right now, imagine the effect of the government borrowing tons of money, the RBI printing tons of money, and the private sector starting to grow again. we've tried this in the past in 2011, 12, 13, where we've simply not been able to withdraw accommodation on time. So we are playing a very, very, tightrope walk right now, where we are hoping and praying that this counter-cyclical actions end the right way. I fear that the degrees of freedom and any incipient rebound can lead to bigger problems than what they actually resolve. Last bit, Neeraj, look, while we spend a lot of time on this fiscal and monetary part, the core issues facing the economy are elsewhere. We need the investment cycle to revive again, which is, paradoxical at a time when growth is so low and capacity utilization is low. But we do have opportunities with FDI. We do have opportunities with government spending on the capital side. But they require a lot of real reforms to come through. All the talk of fiscal and monetary policy takes away the discussion required on banking reform, NBFC reform, real estate reform, land and labor reforms, etc., where I think the real solutions lie.
Well, all pertinent points, and I do hope somebody's listening. Even Nirmala Sitharaman said that please send in your ideas on that particular Twitter handle or the email handle for the budget. I don't know if the budget is the panisha for all things, but maybe it could be a starting point. Ananth, thank you so much for joining in this morning and giving us your thoughts. Appreciate your time as always.
Thank you, Raj.
That's all that we have on First Word today. But after this break, we'll try and talk a bit about the micro as well. For the next 1 hour, we'll focus on the stocks that are likely to move today and in the near term. Stay tuned to BloombergQuint Live.